Imagine buying a coin right before it explodes. You see the resistance line, price finally breaks it, so you hit buy. For a moment, you feel like a genius. Then the trap shuts. The price instantly reverses, your stop loss gets hit, and you're left wondering, what just happened? That's the reality of breakout trading. Most beginners get trapped in fake breakouts. In this video, we'll see how breakout trading really works and how to avoid the mistake that keeps most traders losing. Let's start. Before we talk about how to trade breakouts, we first need to understand what a breakout really is. A breakout happens when the price moves beyond a key level the market has been respecting. For weeks or even months, price often moves between two levels, support and resistance. This phase is called consolidation. During this time, orders quietly build up. Sellers are sitting at the top, resistance level, and buyers are sitting at the bottom, support level. A breakout happens when the pressure from buyers finally overwhelms the sellers. When that ceiling breaks, the price doesn't just move, it surges as short sellers rush to buy back their positions and new buyers jump in, afraid of missing the move. The same idea works in reverse too. When sellers overwhelm buyers and price breaks below support, the market can drop just as quickly. But here is exactly where the trap is set. Most beginners buy the moment price crosses the resistance line. This is called an aggressive entry, and it's one of the biggest reasons traders get caught in fake breakouts. So why do fake breakouts happen? Two words: liquidity hunts. Large institutional traders need massive amounts of liquidity to fill their positions. One way they get it is by pushing prices slightly above a well-known resistance level. This triggers thousands of buy orders and stop losses. Once retail traders rush in, the big players sell into that liquidity, and with no more buyers left to push the price higher, the market quickly reverses and collapses. And this leads to the biggest mistake beginners make: trading breakouts without volume confirmation. If price moves higher, but volume is weak or decreasing, it's like a car trying to climb a hill with an empty gas tank. Eventually, it rolls back down. So how do we trade breakouts without falling into these traps? A simple approach many traders use is called the break, retest, go method. It has 3 simple steps. Step 1. The break. First, look for price testing the same resistance level multiple times. Then wait for price to clearly break above it. Don't enter yet. Step 2. The retest. After the breakout, price often comes back to test that same level again. We want to see if the old resistance becomes new support. Step 3. The confirmation. Look for strong volume and a bullish candle, like a hammer or an engulfing candle, forming near that level. That's your signal that buyers are actually stepping in. By waiting for the retest, you allow the market to prove that the breakout is real. Yes, you might miss the first few percent of the move, but you'll avoid the fakeouts that wipe out most beginners. Breakout trading is one of the most powerful tools in a trader's arsenal, but only if you have the patience to let the market show its hand. Stop chasing the pump. Start trading the structure. Subscribe to Byte Crypto Academy, where we simplify crypto and trading one byte at a time. And if you want to understand how volume confirms real breakouts, check out the video right here.